Hello, my name is Halliday Kinsey, and I'm joined by my colleagues Zain Ali and Nicholas Short. Today, we will be introducing our quant trading framework for cryptocurrency, OScope Crypto. Next slide, please. Thank you. OScope Crypto is a multi-input stream quant model for predicting daily crypto price movements. The inspiration from this project came from a few major areas. The first, if you take a look at the screen, is the volatility of Bitcoin itself and how anything from major world events to single tweets can move the price of Bitcoin significantly. Additionally, each of us are traders and have explored various high-frequency modeling options. However, we've found that a lot of quant models only consider market prices and technical indicators and end up missing a lot of movement signals from other sources, since the chart itself can seem a bit random. Because crypto price movement is more of a perception and lacks traditional valuation like earnings reports and dividends, it is more easily impacted by public sentiment.
And this led us to focus mainly on the news sector, which usually causes huge changes within the crypto price itself. So that was one of the data sets that we pulled in, was the news minute with a grain of minute. And then we also pulled in data for Bitcoin and Ethereum. Initially, our focus was going to be completely Bitcoin, but because we didn't want to be caught up with additional biases, so we decided to have a secondary data point, which was going to be Ethereum.
So the final framework, as we kind of just talked a little bit about, really makes the most of the strengths of a bunch of different kinds of models to make informed Bitcoin trades using technical indicators, engineered features, and news sentiment data. By combining the deep learning architectures with NLP-based news sentiment and benchmark trades, the model's goal is to generate data-driven trading signals that are also incredibly interpretable. So the diagram up here shows our full pipeline for predicting the price movements using both the market data and financial news. All the way on the left side, you can see the data ingestion of both Bitcoin and Ethereum price data alongside the financial news articles. And then using this data, we extracted key features like technical indicators from the price data and sentiment scores from headlines using Finbert. We trained 4 deep learning models to learn temporal and sentiment-driven price signals from the input values, and the predictions feed into a backtesting engine that evaluates each model's performance using accuracy, Sharpe ratio, and other trading metrics. The outputs are then compiled into an interactive report for analysis and future development. Okay, really quickly, let's walk through the deep learning models that we used to forecast the price movement and make trades accordingly. As we've previously discussed, crypto is not your average financial asset. It moves really fast, trades 24/7, and reacts to a lot of social sentiment. So instead of relying on traditional statistical or linear models, we chose 4 deep learning architectures that are better suited for nonlinear and sentiment-influenced movements. So we started with a baseline RNN, which was really good at capturing the sequential dependencies, but it tended to struggle with long sequences and vanishing gradients. And in our case, it showed a little bit of unstable convergence, sometimes overfitting or reacting too heavily to the most recent data points. But that ended up being a little bit of a good thing, since our top goal is to be a profitable trading model, and these are short-term trades that we're making. We also tried a CNN to pick up on short-term price movements and volatility patterns. Our CNN was the most technically accurate model with a lower mean absolute error than both the RNN and GRU. Then we tested a transformer model with multi-head attention, since we figured this would be the most powerful model in a chaotic environment like crypto, particularly Bitcoin. And that would include, capturing things like price momentum, technical indicators, and sentiment data all at once. Finally, we also had a GRU, which performed very well. The GRU kind of hit that balance between memory and retention of past data points, while also efficiency in moving with the trends of the market rather than just being 100% on the price point predictions.
And back to Nick to explain a little bit about the sentimental side of it, because we also had a sentimental model too.
So on a continuation from our for modeling, we are looking at the Finbert model and our sentimental analysis to create our ensemble. So the Finbert model in this case was developed by Process AI and is using the traditional NLP BERT architecture. And in this case, the model is trained on financial and stock-based applications. Now, the output is results in three classes: negative, neutral, and positive. And we can see the distribution in the bottom left corner showing that these are encoded in a -1, 0, and 1 for the negative, neutral, and positive results, respectively. Well, we're seeing a lot of neutral outputs as well as a high amount of positive outputs, but a very minimal amount of negative outputs. And that from there, also the model outputs the softmaxed probability, so a given strength of the sentiment and how confident the model is in the prediction that it has made. So looking at the confusion matrix above, however, we can see that there is a high bias towards the positives. And now this was done mainly due to a very short bullish run, and that can yield a lot of positives. But in the case of distribution, it shows that there's a lot more neutral cases. So the 97% bias towards positive shows that the model still does need some improvement, as well as a more balanced class weighting to make sure that all of the sentiments are covered. Now, looking at the impact that sentiment analysis definitely has on Bitcoin in this case, we are looking at the altcoin Gordon, a prominent coin analyzer, and the things he posts on X, formerly known as Twitter, and how it affects it. So looking at the two comparison graphs here, we see how his positive sentiments posted in the green as every time he posts, as well as the red negative sentiments show different trends. So when there is a red region, it's constantly dropping or leveling out positive increases, while where we see green regions, it is constantly going away from declining presence, as well as trending towards an upward trajectory. And we can see that in the comparison price of the red line versus the outlook on the blue line.
Thank you, Nick. So moving forward, talking about the results that came out of all of our analysis, our accuracies were not that great, to be honest. We're looking at about 0.345 to 0.350, around that range for Bitcoin. And then for Ethereum, we're about like 15% accurate. This, however, was at 10% data level. One of the restrictions that we ran into, we actually had two A100s, but because the models were complex, we had millions and millions of rows. We had a minute-based data. So it was very much an interesting aspect trying to balance that out. And I think some of this is due to our data amount. We just need a lot more data to capture the complexities that does come with the market and the sentimental side, and also the psychology of people. So we, in regards to that, we did one experimentation where we started off with actually 0.01%, and then we did 1%, and then we did 10% of the data to check maybe it's just it's throughout both of those, all three of those versions, if the accuracy is the same. We had a significant change in accuracy as soon as it went from 1 to 10%. So that kind of confirmed that it's just that we just don't have enough data to capture all the complexities. This led us to divert into we didn't want to give this up. There's definitely some usability there, like we had some good recall rate. We had some good precision as well for some of these models. The one issue that we just ran into was yes, all those metrics are very consistent throughout all those models. It's just that those metrics are not great. So what we ended up doing is in market, what is the most important thing is not losing money. So we came up with a strategy where we do buy when the signal is positive, but we essentially pull out of the trade if our stop loss percentage hits, and we put our stop loss about at 0.03%, which is quite low. But what that does help us is essentially like all the false positives, it clears those out. And then we saw that in the confusion matrix as well. So a lot of a lot of the issues that we're having with the sentimental model was the false positive. We just had a huge bunch of false positives. So this kind of takes care of that. Then we went into essentially closing it off when there's a negative, regardless if it's a false negative, that's perfectly fine for us to not gain money as long as we have the guarantee of not losing much. This led to very interesting results. We had, if we had real money and if we had more testing and if it was a realistic model, we would have been a millionaire at this point and you would have seen us not be in this class anymore. But this is theoretically speaking, we had great results. So for CNN within Bitcoin, we had about 13,460% increase. So it's not just it's a percentage. For sentimental, we had a very similar number as well. The issue with sentimental, it was very hesitant to make any trades. So if you see on the bottom, for it only made one trade, and on that it made that much money. So we're still trying to figure out like why, how, and when, but that's kind of the numbers that we came up with within our analysis. For Ethereum, for CNN, like when we're looking at Ethereum, it made about 320 to 3,200 trades, and it came up with a 9,000,000% return. So again, we will have to do further research to kind of confirm there's not huge biases, but these numbers were all quite strong. CNN as well, we had about 44,000% return, just to kind of see what that looks like. If you do see, this is where our stop loss comes really helpful. If you see, our gains are quite, there's no ceiling to them. But whereas our losses have a floor. So as soon as it hits the floor, it pulls out. And even if you look here, even in the downturn of the market, we were gaining overall. There were parts when we're losing money, but we're losing on profits, right? So we're not really losing on our actual value. And that's coming at a very steep end of the curve. And even our lowest wasn't as low as one would expect to be if we were just using the models themselves. And this kind of pushes it, this kind of pushes it to a big decision. This is actually more of a quantitative analysis rather than just being the AI. AI is more of a supportive role in this whole analysis. And this is where it kind of worked out really well, at least in the theoretical sense. So we'll love to go further and study this and see if there's any issues with the current stage. Thank you for listening to this big project. We ran into a lot of obstacles throughout the way, but it was quite a learning curve to a point where we actually got rid of all of our data by accident. So no, that's wrong. That's wrong. We didn't get rid of them. I was gonna make a joke and it didn't really land right. Thank you. Thank you for listening to us. We have a few links for you. So we have all the data under Hugging Face. We also have a repository with all the documentation. We also have a site. The site is a little bit novice. It's very new. There you might run into some static bugs there. We just didn't. We had a lot of our data being lost throughout this process. So, but luckily we were able to recreate some of those aspects. We wanted to actually have a full dashboard. Which again, we'll definitely love to come back to because the site is online. So we'll probably take some time after this project, not for grading purposes, just for you guys to enjoy. But other than that, thank you. Thank you for listening to us. And then thank you.